Hello friends, today we'll talk about one of my all-time favorite books, Common Stocks and Uncommon Profits by Philip Fisher. It was first published in 1958, and it is still so relevant today, because some of the principles he talked about are just timeless. If you have not read this book yet, it's a must-read if you're an investor. So in this video, I will share with you 3 of my most favorite keyways from this book and sort these 3 keyways in numeric order. I will also briefly share why they are my favorites and why you should consider them as well. But before we start, let me quickly introduce myself. I am an investing and data science enthusiast. On this channel, I share my learning and insights about quantitative investing, stock analysis, and financial markets. If you like this kind of content, please hit the like button. And without further ado, let's dive into the topic. So the first keyway I want to highlight from this book is about keeping your mind absolutely free and open. To do that, there are 2 things you need to do. The first thing is never let yourself believe too much in any theories. Theories sound nice, and they make sense, but sometimes they might work for a period of time, but they are not always true. And secondly, avoid getting emotionally involved in what you are doing. When you are analyzing a company, or when you are building your investment thesis, try to separate your emotion and look at the facts only. Otherwise, you may become biased. There is a quote from Fisher that I love very much. He said, "Do not become attached to a theory or an idea or a forecast merely because it has worked well in the past." I think this is very important because if you're going to be investing in the stock market, you have to constantly learn and unlearn, and you have to adapt yourself to the changing world. There are a lot of examples in this book. He gave an example of how people used to say dividends don't matter, right? But over time, they actually do matter. Another example would be growth is king, right? At some point, people used to say that, but then value investing came back in fashion. So you cannot really rely on a theory. You cannot really say, okay, this is the absolute truth. Yes. You have to keep your mind open and be flexible. I also love another quote from this book. It said, "No man ever stepped out of his body and viewed himself from the outside. Therefore, no one really knows how biased he is." This quote is about the second part of how to keep your mind free and open, which is not to get emotionally involved. We all have our own biases. We all have our own stories that we tell ourselves to make sense of the world. For example, I am a person who is risk-averse, right? So I have my own bias. As an investor, it is important for us to be aware of our biases. It's very hard to remove them, but at least you can be aware of them. Yes. So whenever you're analyzing a company, you have to ask yourself, am I being biased here? Am I telling a story to myself? Or am I truly looking at the facts and figures? So this is the first key way that I want to highlight. It's about how to keep your mind absolutely free and open. The second key way I want to highlight from this book is about finding the key factors or key drivers of a company. Fisher called it keyways. He said that you have to find the top keyways and then order them in numeric order. So what does that mean? Let's say you're going to invest in banks, right? What are the key factors that drive the profitability of a bank? Maybe it is the net interest margin, right? Maybe it is the efficiency ratio. Maybe it is the return on equity. Maybe it is the loan growth, right? These are some of the key factors that drive the profitability of a bank. But among these key factors, which one is the most important? In order to answer that question, you have to use your judgment. In experience, you have to look at the company and see which one has the biggest impact on the company's profitability. For example, let's say for this hypothetical bank, the net interest margin is the most important factor that drives its profitability. Then you can put no 1 in front of the net interest margin. The second most important factor could be the loan growth. Then you can put no 2 in front of the loan growth. And the third one could be the efficiency ratio. You can put number 3 in front of the efficiency ratio, and so on and so forth. So this is what Fisher meant by ordering the key factors in numeric order. Let's take a look at this quote from this book. Fisher said, "The first step in analyzing an issue is to find the key elements or key ways, which, in themselves, will explain most of the future changes in the price of the stock. These keyways are usually not more than half a dozen in number, and each one of them is susceptible of fairly objective measurement." I love this definition because he made it very simple. He didn't use fancy words. Instead, he used simple language to explain a complex concept. The reason why I love this keyway is because it gives me a roadmap. It tells me where to go and what to focus on. Because as investors, we have limited time and attention. We cannot pay attention to every single detail. We have to prioritize things. And this keyway gives me a prioritization. I know where to start and what to focus on. Now let's move on to the third keyway I want to highlight from this book. This book is filled with wisdom. I read this book a few years ago, but even now, when I pick up this book and I start reading it, I learn something new. It's amazing. This brings me to the third keyway that I want to highlight from this book, which is about making money while you sleep. Fisher emphasized the importance of buying great businesses and then holding them for a long time. He said that if you buy a good business, and if you hold it for a long time, you will make money even while you sleep. This is what he said. The investor's chief objective should be to buy into businesses, preferably growing ones, with the ability to make good profits on a large scale. The reason why I love this keyway is because it emphasizes the importance of buying a good business. We as investors, we always get excited about the stock price. We always think about when to buy and when to sell. But we often overlook the most important thing, which is buying a good business. A stock is just a tradable ownership piece of a business. If you buy a good business at a reasonable price, you will make money in the long run. There is a great quote from this book. He said, "The goal of this book is to help you to recognize the superior characteristics of such businesses, which, if kept in mind, will enable you to select common stocks with a high degree of confidence." This quote is so powerful because it reminds me of my ultimate goal as an investor. My ultimate goal is not to beat the market. My ultimate goal is not to make a lot of money in a short period of time. My ultimate goal is to grow my wealth steadily over a long period of time. Alright, so these are 3 of my favorite keyways from this wonderful book. I highly recommend you to read this book. It's so insightful. It's filled with wisdom, and it will teach you how to be a better investor. Before we wrap up, I just want to say thank you for watching this video. I hope you enjoyed it. If you did, please hit the like button. If you know anyone who might benefit from this video, please share it with them. Thank you again, and I will see you in the next video. Bye for now.